Contingent Fee Insurance, which is commonly referred to as WIP insurance, it stands for Works in Progress. It provides a guarantee for plaintiffs' law firms who handle matters on a contingent fee basis that they will receive at least part, if not all, of the time they've invested and the expenses they've incurred in the litigation, regardless of the outcome. The way it works is that they pay a one-time premium to a bespoke policy, which provides protection against the downside risk, regardless of what the ultimate outcome is of that matter. Well, first of all, the risk is sent to an underwriting team of insurance underwriters who specialize in designing litigation insurance solutions for known, threatened, or pending litigation. Normally, there's a pretty extensive due diligence process that occurs. They like to review a legal memo from the plaintiff's firm, and they also like to review any of the court filings from the record. The more complete the record, just because it's more information to go on. After they do their initial due diligence, they come back to the potential insured, and they normally have a Q&A just to resolve any remaining open items. They also like to have a conversation with the potential insured to discuss what their legal, business, and financial objectives are. After that, they go to the third-party carrier for final underwriting, and they can propose policy terms and pricing that are in line with the insured's requests. And then lastly, as I mentioned before, they pay a one-time premium to a bespoke policy, and it transfers the outcome risk. Well, first and foremost, it provides absolute cost certainty, which is paramount when you're working with any law firms or corporations these days. As I said before, it provides a guarantee that they will at least receive all or part of the time that they've invested or the expenses that they've incurred, regardless of the ultimate outcome of the litigation that they are prosecuting. But it also helps with litigation funding, and here's why. A lot of plaintiffs' firms that handle matters on a contingent fee basis will go to financial institutions or litigation funders for a loan so that they're not using their own cash to prosecute these types of matters. However, those situations can sometimes be a bit expensive because interest rates are usually high. So if those plaintiffs' firms that handle those types of matters go and they acquire litigation insurance first, then there's protection against the outcome risk, and they can normally borrow at the most efficient cost of capital and at the best rates that are available on the market, because that non-recourse risk has basically become recourse risk because the collateral is now the insurance policy. And there's a couple of other reasons why it's very advantageous to plaintiffs' lawyers as well, and their clients. One is that it allows them to take on more cases. Sometimes a plaintiff's firm may be unwilling to take on a certain case because there's concerns about the outcome risk or the collectability. By leveraging a contingent fee insurance policy, it removes that risk and it allows those plaintiffs' firms to take on a larger book of business, which also gives their clients better access to justice. And then lastly, it helps with settlement negotiation because it removes litigation fatigue, and it can mitigate that notion that a cash-strapped plaintiff may be willing to settle on the cheap because there is a guarantee of the outcome of the litigation backed by the insurance policy.